Hey, welcome back. Today we're going to slow down and walk through the full checklist of what you should verify before trying to buy a house with only about $1,000 out of pocket. I know it sounds almost impossible, but once you understand how the USDA loan program works, the MAP zones, the income limits, the debt ratios, the appraisal rules, it becomes a straight step-by-step process rather than a mystery. After more than 12 years in real estate finance and investment, I've watched these steps save buyers thousands of dollars and prevent expensive mistakes that could stay with them for years. Most people don't realize you can walk into a home purchase with as little as $1,000 when you understand the right loan programs, the right limits, and the right trade-offs. Grab a pen and take notes. I've been investing and guiding buyers through USDA deals and low down payment structures for over 12 years, and I've seen the same pattern repeat itself in every successful purchase. The difference between someone who closes successfully and someone who walks away frustrated usually comes down to preparation, not luck. In this chapter, we'll go through each factor I personally review before making a move or advising anyone else to. These aren't theoretical concepts. They're the exact checkpoints I use in real deals. Here's what I'd check before ever putting a dollar into this. I always start by confirming whether the property qualifies under USDA guidelines. This is the foundation of the entire strategy because USDA loans only apply to homes located within a defined MAP area. Many people assume rural means farmland, isolation, and long dirt roads, but in practice, USDA-eligible areas often include suburban communities about 20 to 30 minutes outside major city limits. You'll want to verify eligibility by checking the official White's USDA property map, which is publicly available online. You type in the property address, and the system will show you whether it falls inside the approved zone. I've done this dozens of times myself, and it takes less than 2 minutes. The tool is straightforward. You enter the street address, city, and state, and it returns a clear yes or no answer with a visual map overlay. Understanding this matters because the USDA program exists to encourage homeownership in low to moderate density regions. According to USDA documentation, the purpose is to support population growth and stabilize regional economies by offering 100% financing options. In simple terms, the loan covers the entire purchase price when the home is inside their boundary. If that boundary line cuts off one street early or one block short, the loan isn't available for that property. I've seen buyers waste weeks negotiating contracts only to discover the property wasn't eligible. They spent time, energy, and sometimes even paid for inspections before realizing the deal was impossible from the start. When you start here, you eliminate 80% of early confusion. Good investors think in systems, and USDA eligibility is the first system checkpoint. Before moving forward with any excitement or emotional attachment, confirm the map. It's that simple. This step protects you from investing time in properties that will never qualify. It's the difference between a smooth process and a frustrating dead end. Next, you'll want to confirm that your credit score meets the USDA minimum, which is typically around 620, depending on the lender. I always tell people that your score doesn't have to be perfect, but it does need to be stable. Most lenders determine risk by reviewing all three major credit bureaus, Equifax, TransUnion, and Experian, in what's called a tri-merge report. They usually take the middle score, not the highest or lowest. Most people skip this step and end up frustrated not realizing that the lender uses a different scoring model than popular apps like Credit Karma. Those consumer apps often show scores that are 10 to 30 points different from what lenders actually see. The difference comes from scoring models, and some apps use VantageScore while lenders typically use FICO models for mortgage decisions. Credit matters because it signals your repayment history and financial consistency. Based on what lenders analyze, late payments within the last 12 months tend to be the biggest warning sign. Credit utilization also plays a role, and most lenders prefer to see it under about 30%, depending on the file. If you're sitting at 60 or 70% utilization across your credit cards, that raises concern. It suggests you're relying heavily on credit to manage monthly expenses, which increases perceived risk. The goal here is not perfection, it's predictability. A score around 620 tells the lender you're stable enough to manage a mortgage. When you understand this part, stress levels drop. You're not guessing whether you'll be approved, you're verifying it with real data. This is one of those quiet steps that prevent surprises later. I recommend pulling your own credit report at least 60 days before starting the home search so you have time to address any errors or dispute inaccuracies. Most credit bureaus allow one free report per year, and it's worth reviewing every line item carefully. Now let's move deeper into your financial ratios. Your debt-to-income ratios, often called DTI, are one of the most important USDA requirements. Lenders break this into two numbers: the front-end ratio, which compares your housing payment to income, and the back-end ratio, which compares total monthly debt to income. These ratios show how much financial pressure you have each month. You'll want to confirm that your existing debts, credit cards, auto loans, student loans, don't crowd out your ability to afford a mortgage payment. USDA guidelines typically allow a back-end ratio around 41 to 45%, depending on compensating factors and lender discretion. Some lenders push it slightly higher if you have strong credit or significant cash reserves, but those are exceptions. The back-end ratio includes everything: your proposed mortgage payment, property taxes, homeowner's insurance, any HOA fees, plus all recurring debts that appear on your credit report. Analysts verify this by reviewing tax returns, W-2s, and pay stubs, along with your credit accounts. When your ratios are too high, lenders may recommend paying down smaller balances or restructuring payments before approval. I've guided clients through this exact process, and the solution is usually straightforward once you see the numbers. Sometimes paying off a small credit card or an auto loan with only a few months remaining can shift your ratio enough to qualify. Again, this isn't guesswork. It's measurable, verifiable math based on monthly obligations. By understanding your ratios early, you control the process instead of reacting to issues midway. Good investors measure risk before they commit capital. They don't move forward hoping things work out. They verify the numbers first. This discipline separates successful buyers from those who struggle through the process. If you've gone through bankruptcy, and many responsible people have, you need to know your discharge date. USDA requires about 2 years from that date before you qualify for a loan. I've sat across from many buyers who thought they needed to wait 5 to 7 years. That's simply not true. USDA guidelines are surprisingly flexible as long as there has been financial recovery and consistent payment history post-discharge. Lenders confirm the discharge date through court documents and your credit reports. What matters is that the bankruptcy is closed, the discharge is official, and you've had time to rebuild. The key is proof of stability, not perfection. Depending on your file, you may also need to show that any debts included in bankruptcy have been cleanly resolved. I've worked with buyers who came out of Chapter 7 bankruptcy and successfully closed on USDA loans within 24 months. The timeline starts from the discharge date, not the filing date, so make sure you're counting from the right milestone. It's not about judgment, it's about timing and documentation. Good investing is about clarity, not fear. Once you know the rules, you can plan logically. Bankruptcy doesn't disqualify you forever. It just pauses the process temporarily. The goal is to show that you've reestablished credit and maintained consistent payments since the discharge. That pattern of recovery is what lenders evaluate. They want to see that you've learned from the experience and returned to financial stability. Lenders want to see consistency, usually a minimum of 2 years on the job or within the same industry. This doesn't mean you can't change employers. It simply means your income pattern needs to show predictability. I've helped clients through this process countless times, and the key documents are always the same: W-2s, pay stubs, and tax returns. According to industry standards, stable income is one of the strongest predictors of mortgage repayment. If you're self-employed, you'll want to prepare at least 2 years of tax returns showing business income. Analysts look for trends, ideally upward or steady, not declining. If your income dropped 30% year over year, that triggers additional scrutiny. You don't need to be rich. You need to be consistent. The lender isn't judging your career path, they're confirming you can handle the monthly obligation. Most salaried employees pass this requirement easily. Contractors, freelancers, and small business owners need to document income more thoroughly. Self-employed borrowers often face more documentation requests because their income can fluctuate significantly. Lenders may average your income over 2 years and use the lower figure to be conservative. When you verify your employment foundation early, everything else becomes easier. This step shows the lender you're not a flight risk. It demonstrates that you have a reliable source of income to cover your mortgage payment month after month. Employment stability matters because it reduces the lender's risk and increases your approval likelihood significantly. One advantage of USDA loans is that sellers are allowed to cover closing costs, usually up to around 6% of the purchase price, depending on region and lender. This can include appraisal fees, title fees, prepaid items, and even a home warranty. I've seen sellers agree to these concessions many times because it helps the deal move forward without issues. From their perspective, it's cleaner to include these costs in negotiation rather than risk losing a qualified buyer. In competitive markets, this might be harder to negotiate, but in balanced or slower markets, sellers often accept it willingly. Sometimes they'd rather close the deal than wait for another buyer who might not have financing in place. Analysts confirm allowable contributions through USDA guidelines and lender-specific overlays. This step matters because closing costs can add up, typically around 2 to 4% of the purchase price depending on the region. On a $150,000 purchase, that's $3,000 to $6,000. When the seller pays these costs, your out-of-pocket commitment drops significantly, which is how the $1,000 house purchase becomes realistic. Smart investors understand leverage. You're not asking for charity. You're structuring a deal that works for both sides. The seller gets a committed buyer with verified financing, and you get help covering upfront costs. It's a win-win structure built into the program guidelines. This is one of the most powerful features of USDA loans that many buyers don't fully utilize. Earnest money is a deposit showing you're serious about buying a home. In USDA-style deals, it's often around $500 to $1,000 depending on local norms. The key point I always emphasize is that this money is not lost. It is credited back to you at closing or refunded if you cancel within inspection timelines. According to standard contract practices, earnest money is held in escrow and remains protected by contract terms. The escrow company acts as a neutral third party. This matters because people fear losing money up front. But when you follow the contract process, earnest money becomes a temporary holding, not a cost. The amount varies by market, but lenders and escrow companies confirm its status in writing. In some regions, earnest deposits run higher, $2,000 or $3,000, but that's still refundable under the right conditions. The contract specifies contingencies: inspection, appraisal, financing, and as long as you cancel based on one of those contingencies within the allowed time frame, your earnest money is returned in full. A good planning means knowing where your money is at all times. You're not gambling. You're securing your position in a structured transaction. This deposit shows the seller you're committed, but it doesn't put you at financial risk when handled correctly. Understanding this removes one of the biggest psychological barriers to moving forward with a purchase. A professional inspection is your safeguard. I always recommend hiring a licensed inspector, not a friend, not a relative, someone qualified to produce an objective report. Inspectors typically deliver a 50 to 80-page document showing structural, mechanical, electrical, and plumbing conditions. It may look alarming, but it's normal. The inspector is paid to be thorough. Their job is to document everything from minor cosmetic wear to major foundation concerns. The purpose is to verify the home's condition before moving forward. Analysts check for safety issues, mold, electrical hazards, roof problems, and HVAC risks. According to industry norms, inspection fees usually cost around $300 to $500 depending on region, and this is generally the only true non-refundable expense in USDA deals. Some inspectors charge more for larger homes or additional services like radon testing or septic evaluations. The inspection typically takes 2 to 4 hours depending on the size and age of the home. This step gives you leverage, not stress. The report becomes your negotiation tool in the next phase. It provides documented evidence of issues that need attention, which gives you factual grounds to request repairs or price adjustments. Never skip this step to save a few $100s. It protects you from thousands in unexpected repairs later. Once you have the inspection report, you can request repairs or credits. I've supported countless buyers in creating repair lists that target major items only. No eat. Electrical issues, plumbing leaks, roof concerns, HVAC problems. Small cosmetic items are negotiable, but major safety issues should be addressed before closing. You're looking for structural integrity and system functionality, not perfection. Negotiation is a simple back and forth. The seller may agree, counter, or decline. You then decide whether to proceed or cancel. The value of this step is that it protects you from hidden costs after closing. Everything is documented, itemized, and verified through receipts from licensed contractors. If the seller agrees to replace the water heater, you'll receive proof of installation. If they offer a credit instead, that amount is deducted from your closing costs or added to your earnest refund. Some buyers prefer credits because it gives them control over how and when repairs are completed. Others prefer the work done before closing, so they move into a fully functional home. Good investors protect downside risk before upside potential. This phase separates emotional buyers from strategic ones. You're not being difficult, you're being thorough. The inspection report gives you leverage based on facts, not feelings. The appraisal determines whether the home is worth the purchase price. Lenders require it to confirm the loan amount matches market value. Appraisers compare the home to recent sales within a 3-mile radius, reviewing square footage, bedroom count, upgrades, and condition. According to industry data, appraisers focus on closed sales within the last 6 months whenever possible. They adjust for differences. If your home has an extra bathroom or finished basement, the appraised value reflects that. If the appraised value meets or exceeds your purchase price, you move forward. If it does not, this triggers another negotiation phase. Lenders will not finance above appraised value, not even by $1. That rule protects you and the bank. The lender is limited by the lower of the two numbers, your purchase price or the appraised value. Understanding this step helps you avoid paying more than market value. Appraisals aren't opinions. They're data-driven assessments based on comparable transactions. Appraisers are licensed professionals trained to evaluate properties objectively using standardized methods. They're not influenced by your excitement about the home or the seller's asking price. They look purely at market data. This objectivity is valuable even when the results aren't what you hoped for. If the home appraises low, you have 3 options. Ask the seller to reduce the price, split the difference, or walk away. I've seen all 3 happen in real-world deals. The lender will only finance up to the appraised value, so any difference must be covered by you, and that defeats the $1,000 strategy. That's why negotiation is essential here. Market trends influence appraisals. When demand is high, some sellers overprice. According to most analysts, this is common in fast-moving markets. Buyers get emotional, Multiple offers drive prices up, and appraisals bring reality back into focus. So when the appraisal comes in low, it simply means the market disagrees with the asking price. Use that fact as leverage. You're not being difficult, you're being rational. Smart investing is about math, not emotion. If the seller won't budge and you don't have extra cash, walking away is the right move. Protecting your downside always comes first. Sometimes a low appraisal feels disappointing, but it's actually protecting you from overpaying. That objectivity is valuable even when it disrupts your timeline. The appraisal process exists to ensure fair market value for everyone involved. Your lender is your guide through the process. A good lender reviews your credit, explains income limits, and helps you understand what adjustments you need to qualify. Most reputable lenders offer free coaching because they get compensated only when you actually close on a mortgage. They review your tri-merge credit report, analyze ratios, and verify employment. According to federal mortgage guidelines, lenders must document income using tax returns, pay stubs, and W-2s. They also cross-check credit sources through all three bureaus. When a lender communicates clearly, the process becomes predictable and stress-free. I always recommend interviewing at least 2 or 3 lenders before choosing one. Ask about their experience with USDA loans specifically, because not all lenders handle them equally well. Some specialize in conventional financing and treat USDA loans as secondary products. Others focus heavily on USDA and rural housing programs, which means they understand the nuances better. Working directly with your lender creates momentum. They'll guide you through document requests, answer questions about timelines, and keep you updated on underwriting progress. This relationship matters more than most buyers realize. A responsive, experienced lender can make the difference between a smooth closing and a frustrating delay. Communication quality directly impacts your experience throughout the entire process. USDA loans are unique because they include income caps based on household size. For a family of 1 to 4, limits typically range from around $103,000 to over $200,000 depending on the state and county. Analysts calculate these limits using area median income data published by the USDA and the Department of Housing and Urban Development. These caps exist because USDA loans are designed for low to moderate income households. You'll want to verify your household income before moving forward. This ensures you fall within the guidelines and prevents surprises late in the underwriting phase. The lender will cross-check this using documented income sources. If you're close to the limit, timing matters. A raise or bonus could push you over the threshold, so plan accordingly. This step brings clarity to affordability. It's not about hiding income, it's about confirming eligibility before investing time and money. Income limits are updated periodically, so always check the current year's figures for your specific county. What qualified last year might not qualify this year if the limits changed. This verification step takes only a few minutes but prevents significant complications later. The USDA MAP tool is non-negotiable. Before paying for inspections or appraisals, you should enter the full property address and confirm eligibility. The tool highlights approved zones and excludes areas that fall outside the program's guidelines. This quick step saves people from accidentally spending money on homes that do not qualify. According to USDA MAP data, eligibility changes over time based on census updates. That's why checking the official map is essential, not relying on word of mouth or outdated assumptions. One street can make a difference. I've seen properties on one side of a road qualify while the other side doesn't. The boundary lines are precise, not flexible. This step prevents wasted effort. It takes 2 minutes and costs nothing, yet it's one of the most overlooked steps in the entire process. Real estate agents sometimes assume a property qualifies based on location alone, but assumptions aren't enough. Always verify directly through the official USDA tool. This simple verification protects your time and prevents disappointment. The USDA loan structure is simple. 100% financing, no required down payment, seller paid closing costs allowed, and income limits based on household size. This structure is what makes it possible to buy a home with only about $1,000 out of pocket. Your only unavoidable expenses are the inspection and the refundable earnest money. Everything else can be financed or covered by the seller within the allowed limits. According to lender disclosures, USDA loans also require mortgage insurance, usually called a guarantee fee, but it is built into the loan amount, not paid up front. This keeps your initial cash requirement extremely low. The guarantee fee is typically around 1% of the loan amount at closing, plus an annual fee of about 0.35%, but both are rolled into your monthly payment. Understanding the loan structure gives you full control over the process. You're not relying on luck or loopholes. You're following a federally backed program designed to make homeownership accessible. The program has been around for decades and has helped millions of families transition from renting to owning. It's stable, predictable, and transparent when you follow the guidelines correctly. This clarity removes mystery and replaces it with actionable steps. When you look at all of these steps together, the process stops feeling overwhelming. Each part tells a story about risk, stability, and preparedness. Good investors think in systems, and when you verify each system, risk becomes measurable instead of mysterious. Buying a home with $1,000 is not luck, it's planning, structure, and following a proven sequence. Every decision point has a clear answer once you slow down and check the numbers. The strongest portfolios aren't built in excitement, they're built in confirmation. Every number, every note is a piece of a longer story, steady, patient, and true. In the next part, we'll break down how to compare two USDA-eligible properties side by side and what numbers I personally check before deciding which home is the better long-term investment. We'll also look at monthly payment scenarios so you know exactly what you're signing up for before you commit.